FinWizard is an educational platform to learn about finance and seek financial advice from the best advice.
7 Retirement and investment myths that are costing you money. We all hope to retire one day. You may even be someone who dreams of an early retirement. That's an admirable goal, but are you putting it out of reach by clinging to common retirement and investment myths? At Edition Financial, we're committed to helping our members make the best financial decisions. The only way to do that is to educate them about financial realities. We recently asked our members and some financial experts about the retirement and investment myths that cost people the most money. Number 1. You don't need to save for retirement while you're young. Our first myth is a very common one, and if you believe it, it could mean that you wind up without enough money to retire comfortably. A lot of people believe when they're in their 20s and 30s they don't need to worry about saving for retirement. This retirement myth is dangerous. The truth is that it takes a lot of time to save for retirement. The earlier you start, the more likely it is that you'll have a sum that will allow you to retire without worrying about money. Whether you contribute toward an employer-sponsored 401k account or open a personal IRA, you should begin saving immediately. The money you invest now will have plenty of time to grow, and you'll also have time to ride out any fluctuations in the stock market. Number 2, you can luck into a retirement fund. Quite a few of our members mentioned retirement myths that are rooted in common sayings about money. They might seem funny, but there's a kernel of truth in them because many people do rely on luck when it comes to saving for retirement. Here are a few examples of what we mean. Successful retirement planning can be achieved through buying lotto scratch-off tickets. There's a pot of gold at the end of the rainbow. Pick a career you love and money will come. Silly, right? The truth is that retirement requires planning. If you don't have a concrete plan for retirement, you may find that you don't have enough to stop working when the time comes. The best retirement plan is one that's consistent. We suggest committing to saving a percentage of your take-home pay. If your employer offers a retirement plan, contribute the maximum amount allowed and make sure to take advantage of employer matching contributions. Number 3, 401k plans are a waste of time and money. 401k plans are easily the most popular kind of retirement savings plan. According to CNBC, half of all Americans have access to an employer-sponsored plan. Many people do contribute to 401k plans, but some don't. One myth that we heard from our members is that some of them were told contributing to a 401k was a waste of time and money. A related myth says that a stock market crash would lead to a total obliteration of 401k savings. As with most money myths, there's a tiny kernel of truth hidden in this myth. There is risk associated with any investment plan. If you have a 401k plan and put a significant percentage of your contributions into the stock market, there is a chance that you will lose money in a market decline or crash. However, it's important to remember that stock investments always ebb and flow. That's inevitable, and it's something we all need to accept if we want our money to grow. Even more importantly, stock market trends over time trend upward. If you can keep your head and leave your investments alone, the odds are in your favor. If you prefer, you can mitigate your risk by managing your asset allocation and putting more money into exchange-traded funds, which spread your risk over multiple stocks. Number 4, the rule of 100 for asset allocation. Our next investment myth comes from Brian Davis of Spark Rental. He brought up the well-known rule of 100 for asset allocation, which says that an investor should subtract their age from 100 to determine what percentage of their assets to put into the stock market. He says, today, that rule leaves most Americans underexposed to stocks, overinvested in bonds, and with no exposure to investment real estate. Americans should instead subtract their age from 110 or 120 to determine their stock allocation. And consider diversifying into real estate as well through REITs, public or private, or some other form of direct or indirect investment. We can't tell you what your tolerance for risk is, but we think Brian's rule is a good one. If you're 35 years old, you can probably afford to put 75% to 85% of your assets into stock. That gives you the best possible chance to grow your investment. Number 5, if I contribute to a retirement plan, I'll be able to retire. Another myth we heard from a financial expert may lead people to contribute less to their retirement plans than they should. We know some people think the fact that they're contributing to a retirement plan ensures they'll be able to retire. Your retirement plan contributions will likely not be enough to ensure a work-free retirement. So you may want to find other areas like real estate and or life insurance to sink some additional money for retirement. For example, if you start contributing to your IRA at age 30 and max it out each year until age 60, you will have contributed $150,000 towards retirement. Assuming a 7.2% rate of return, you would have over $525,000 at age 60, not bad. But if you live another 30 years, that means you have approximately $17,500 per year to live on, not including Social Security. Number 6. Savings accounts are safer than retirement plan. It's a common misconception that it's safer to put money in a savings account than in a retirement account. The truth about this myth depends on your definition of the word safe. Here's what Krista has to say about it. If your goal is to have a set amount of money today, let's say $10,000 for our example, and it still be there in 20 years, then yes, a savings account may be the way to go. The problem is, in 20 years, you will theoretically have less money because $10,000 today will purchase way more than $10,000 will in 20 years. Because of inflation, you would likely actually be guaranteed to lose purchasing power with a safer investment like a savings account. Stocks, bonds, mutual funds, index funds, and even real estate are riskier and more volatile for short-term returns, but over long periods of time tend to produce returns that keep up or outpace inflation, which in my opinion makes them less risky investments for buy and hold strategies, such as retirement. Savings accounts are ideal for short-term goals, such as buying a new car or taking a dream vacation. Number 7, you need a lot of money to start investing. Our final myth is one that we hear time and again from our Edition Financial members. There's a persistent belief that only rich people can buy stock. If there's one investment myth we could debunk for good, we'd pick this one. Why? Because it stops people from investing their money and ultimately, may prevent them from retiring in comfort. The truth is that anybody can invest their money. You don't need to be wealthy, and even investing a tiny percentage of your income is better than investing nothing. We suggest starting with a set percentage of your take-home pay. Even putting 3% of what you make into investments will be enough to get the ball rolling. As your income grows, you can contribute a higher percentage. Investment money and saving for retirement are two of the best things you can do to secure your financial future.
Subscribe to us for amazing financial content and press bell icon.